The Fed coming off a big test in its efforts to calm the short-term funding market. Dom Chu joins us now with the latest on the Fed's repo operations. Hi, Dom.
All right, so Courtney, the biggest banks in America tapped the New York Federal Reserve for $63.5 billion worth of overnight cash borrowing via the repurchase or repo market. That was earlier this morning. The Fed would have allowed up to $100 billion of those loans, so the offering was securing overnight cash, and it was undersubscribed. Now, one of the more positive interpretations of this is that there isn't as much of a pressing need to access Fed cash as there has been in recent weeks, meaning ultra-short-term interest rates have now stabilized. Now, it was a closely watched money market operation this morning, given that surge, as you can see there, in overnight borrowing rates that occurred earlier in the month. Some had said that the surge in rates could signal the early stages of a possible credit event that could lead to a broader market downturn. The Federal Reserve itself then stepped in to supply cash to the system through overnight and two-week term repurchase agreements or repo agreements to make sure that the financial system was adequately supplied with cash. The bottom line here, folks, is that it worked. There is a consensus, though, building up that one of the reasons for the spike in those rates had to do with the unintended consequences of the Fed's efforts to boost cash in the system in the wake of the financial crisis a decade ago. You mix that with new bank regulatory requirements on capital. You mix that with seasonal demands for cash by big bank clients, and you get what we saw. The bank-to-bank lending market plays a mission-critical role in the way our financial markets operate, but up until now, it's only really been talked about by those in the cash and collateral trading businesses and money market circles. It is now fair to say that much of Wall Street is now paying a lot of attention to those money markets as a possible indicator for any kind of potential systemic stress in the future. Sir Carl, those rates, very key for right now. They are stable. We'll send things back over to you.
Hey, Dom, given that today is the last day of the quarter, I mean, is there a sense out there that, this has been taken care of? There was a lot of anxiety that quarter end would be a bit of a flare-up moment for this market.
That's exactly right, Mike. And so there was this kind of overnight operation put into place today. But remember also, throughout the course of the past couple of weeks, we have seen a string of these overnight operations. And then we even saw a two-week operation happen over the course of the last week or so. So the idea there was that between these multiple overnight one-day operations and one where you had longer terms that would carry you into October, that you could see some of those funding stresses alleviated. And we have seen that. And one of the trends that we will point to is that over the course of the last week and a half, guys, we have seen the use of these Fed credit lines for these repurchase agreements used less and less, undersubscribed, so to speak. So it may indicate that the bank-to-bank lending market is taking over where the Fed would have been. So that's probably a good sign for some out there, guys.